Good evening, and thanks for joining us at Australian Retirement Trust annual member meeting for the year ending 30th of June 2024. My name is Beth Mole, and I'm Deputy Chair of Australian Retirement Trust, and I'm delighted to be your Master of Ceremonies for tonight's event. I'd like to begin tonight by acknowledging traditional owners across the country.
At Australian Retirement Trust, we're here for all Australians, today and every day throughout your working lives in retirement. We acknowledge that we work and live on the lands that have been cared for by Aboriginal and Torres Strait Islander people for over 65,000 years. At Australian Retirement Trust, our communities span far and wide, from Meanjin and Warren in the east to Boorloo in the west, to Naarm and Lutruwita in the south, and as far north as Zenith Cass. As we gather today, we acknowledge the traditional custodians of these lands and waters and their continuing connection to country and community. We pay our respects to elders past and present and to all Aboriginal and Torres Strait Islander people. We recognise the diverse cultures, laws and elders across Australia. We strive to listen and learn from this legacy to help create a better future for all generations, no matter where you are or where you're from.
I pay my respects in particular to Turrbal and Yagara people as we meet in Brisbane or Meanjin, to elders past and present, and to all First Nations people with us tonight. For those of you who attended the annual member meeting in November 2023 and provided feedback, thank you. That feedback has been used to help shape our agenda and our Q&A approach for tonight. We will start with short updates from ART's Chair Andrew Fraser and Chief Executive Officer David Anderson, followed by an investment performance and strategy update from our Chief Investment Officer, Ian Patrick. We'll then hear from you, our members, and answer your questions. It's important to us to ensure you have the information you need and want from us, your super fund, whether online or in person tonight. If you're joining us on the webcast, we will open the Q&A following the speaker's update. You will then have the opportunity to submit your questions online. This year, you can also vote for questions that have been submitted online, so we encourage you to have your voice heard by voting on what you want to hear about. If you are here in the room, once our speakers have concluded, I'll invite you to line up behind one of the microphone stations if you have a question. We will try to answer as many of your questions as we can tonight, but we may not get to everyone. Rest assured, we'll publish on our website the answers to any submitted questions we haven't had time to answer. Finally, before we get underway, I need to let you know that the information we are providing tonight and any opinion given by our speakers is general information. It is about Australian Retirement Trust as a whole and doesn't take into account your specific circumstances or financial situation. Our presenters will also provide you with information about how ART's investments have performed, but it is important to understand that past performance is not necessarily indicative of future performance. I'd now like to introduce Andrew Fraser, Chair of Australian Retirement Trust. Andrew has been ART's Chair since October 2022 and joined as a Director in 2015. Andrew was also a Non-Executive Director of the Bank of Queensland, Director of B6 Watpac and Brisbane Broncos Limited, and President of Motorsport Australia. He is the Chancellor of Griffith University and serves as Chair of Orange Sky Australia and as a Director of two other charities. Together with the other members of the ART Board, Andrew is responsible for ensuring that ART operates in our members' best financial interests, delivers on our objectives, and complies with legislation. Please welcome Andrew.
Thanks, Beth, and good evening, everyone. I also choose to begin by acknowledging the first peoples of this land, the Turrbal and Yagara peoples, and acknowledge the truth of their original and enduring custodianship. It's once again an honour to join with you, our members, this evening to report on what Australian Retirement Trust has achieved over the past year for you, our members. While the developments that we report on each year may vary, the obligation behind them remains steadfast, delivering benefits to you. We know confidence in your financial future is of the utmost importance to all of you, and that's especially so in challenging economic times. And we take seriously our responsibility to safeguard and focus on growing your retirement savings with strong governance, sustainable growth, and above all else, world-class investment performance. The last financial year has been a critical year for ART and the way we deliver to our members. Last year, I outlined plans to bring together a unified investment menu as we merge the portfolios of investments to enable the benefits of scale and the power of choice. That unification is now complete, and with all of our 2.4 million members now able to select from a streamlined suite of leading choice investment options across accumulation and into retirement. Your Chief Investment Officer, Ian Patrick, will share more detail on the performance of these options shortly. The way your fund operates has also been streamlined, with a new operating model that's been implemented to create simplicity and to position us to focus on delivering world-class performance where it matters most, in investments, retirement income solutions, member and digital experience, and governance. Overseeing this change was your new Chief Executive Officer, David Anderson, who will share more in his first address to you shortly. We welcomed David to the fund in March this year, and the board and I believe his experience, leadership style and values will enable him to be a truly outstanding CEO of Australian Retirement Trust, and one who's focused on the priorities that will underpin ART's continued performance both now and into the future. Growth of the fund has always been important to our ability to achieve economies of scale and to access larger investments right around the world on your behalf. The last financial year has been one of our largest for corporate transitions, with close to 100,000 members joining us from major corporates, including household names, solidifying ART's position as a fund of choice in this country. There are more transitions in the pipeline, with announced plans for QuantaSuper to merge into ART in the early part of 2025. Like the operation of the organisation, the board has evolved to strengthen our expertise in investment, governance, risk management, cybersecurity, insurance and climate risk, all areas of increasing importance in our industry and to you as members. This year we were joined by two new independent directors. I'm proud to formally introduce to you Dr. Martin Parkinson, AC, who's the current Chancellor of Macquarie University and has previously served as the Secretary of the Department of Prime Minister and Cabinet, Secretary to the Australian Treasury, the inaugural Secretary of the Department of Climate Change, and also served on the Reserve Bank Board of Australia. Martin's joining us online this evening. And I'd also like to introduce Helen Rowell, who's on the stage with us this evening. Helen brings more than 20 years of experience at APRA, the Australian Prudential Regulation Authority, including 10 years as an executive board member and deputy chair for the regulator across both superannuation and insurance. We welcome their insightful leadership to the ART board as we steer through a changing and complex environment. They help bolster the existing strength of ART's board to enable us to implement the highest standards of risk management, operational resilience and investment governance. During the year, Michael Trail AM, Janine Walker AM and Georgina Williams retired from the board, and I take this opportunity to thank them on your behalf for their dedicated service to ART and indeed to its predecessor funds. In closing, thank you. Thank you for your continued trust and support. Together we look forward to another year of growth and opportunity, and I look forward to answering your questions later this evening.
Thank you, Andrew. I'd now like to introduce David Anderson, Australian Retirement Trust's Chief Executive Officer. We welcomed David to ART in March this year after a global search to appoint a new CEO. David has more than 30 years' experience in insurance, financial services and professional services, having led teams across the globe. He is a member of the Australian Institute of Company Directors and a fellow of each of the Association of Super Funds of Australia, the Australian Institute of Management, the Australian and New Zealand Institute of Insurance and Finance, and the Australian Marketing Institute. Please welcome David.
Thanks so much, Beth. Good evening, everyone, and I also warmly welcome and thank you for joining us here and online. It's a real pleasure for me to be here with you all for the first time to deliver my inaugural address as the Chief Executive Officer of Australian Retirement Trust. Your fund has had a very successful year, and I'll share more about that shortly, as will Ian. My wife and I moved to Brisbane at Easter after spending 9 years living in New York and London. Returning to Australia to lead Australian Retirement Trust for the last 9 months has been an honour and a privilege. I'm inspired by the dedication and talent of my colleagues and their work to enable you to have your best retirement. Late last year, I was working diligently in a global role spanning 46 countries, and my wife and I were living happily in London, and we had no plans for a big change. And then I was alerted to the role of CEO at ART, and it was an opportunity that was just too great not to pursue. Less than a year later, here I am with you all this evening. So what motivated me to relocate to Brisbane and take on the leadership of ART? I saw an incredible opportunity to help ART become the best retirement savings and income fund in this market, and to bring my global learnings and experiences back to Australia to benefit ART members, my colleagues, our industry and society. This remains my very clear objective, and I'll contribute my all to make it happen. I want to publicly thank Andrew and our board for providing me with the opportunity to make a difference for you, our members, and for their great support and guidance over the past 9 months. In my early months, I spent a lot of time listening to our members and learning from my colleagues. Our member-first culture was strikingly evident from the moment I walked through the front doors of ART. My colleagues are earnest in all they do and are committed to doing their best for you. Since commencing at ART in March, I've reviewed every business area. I spent a lot of time in direct contact with our members and essential partners, including employers, unions, business chambers, and financial advisors. I've engaged routinely with our regulators, collaborated with my industry peers, and I've worked with our board and executive to clarify our aspirations and strategic priorities. As Andrew mentioned, to simplify our operating model, to invest in our frontline member services teams, and to develop our enterprise purpose and values. At ART, our purpose is, we inspire confidence and awaken futures. This is the right statement for purpose, inspiring confidence through our conduct as a responsible institution and awakening future possibilities for our members and colleagues as a leading fund and employer. Our values describe how we bring to life our purpose every day through empathy, courage, and excellence. Super is one of life's biggest investments and one of your most valuable assets. We have a responsibility to you to continually strive to deliver the best investment returns and retirement income solutions, the best member and digital experience, and the best governance of your fund. Which is why we're disappointed about a technology system disruption at the end of October. For several days, some of our members could not access our online services, and some members, just less than 1% of our members, received delayed income payments. I want to assure you that this was an internal technology error and not a result of a cybersecurity breach. Our teams worked around the clock to identify the cause and remedy the system disruption. We fell short of your expectations on this occasion and the expectations that we have of ourselves. And if you were one of those that were affected, I apologise. Given recent media articles about service standards and complaints for large super funds, I believe it's important to share our perspective on these with you. There are service areas where we can and will improve, and under my leadership, we'll always seek a better way. However, we're pleased to share customer satisfaction for ART is at 85%, and based on Australian Financial Complaints Authority data for the financial year 24, ART had one of the lowest rates of complaints per member out of comparably sized super funds. We will, however, always strive to be better. As Andrew mentioned, I joined in what has been a critical year for ART as we realised further benefits from the merger of 2022 and considered how we'll unlock further efficiency and economic value to benefit you. We completed unification of our choice investment menu on July 1. Alongside that, our teams completed data integration projects, consolidated finance and people systems, invested in world-class cybersecurity measures to safeguard member account data. And growth has been a hallmark of this past financial year. Growth benefits all members through greater economies of scale and lower costs over the medium to long terms. We grew your fund by $45 billion in FY24, taking funds under administration to more than $310 billion to now serve almost 2.4 million members who trust us to guard and grow what is for them their longest term investment. While Ian will provide more detail about our investment performance, I'm really pleased to highlight the performance of ART's high growth investment option, which delivered a double-digit return for the second consecutive year. From July 1, we refined our Sunsuper default investment strategy to reflect contemporary thinking around investing retirement savings more generally. The strategy now includes a higher growth allocation for longer, while continuing to transition members from higher to lower risk investments in their lead up to retirement. The vast majority of our Sunsuper members are now invested in a strategy equivalent to ART's high growth option. In the past year, we also launched our new brand platform, urging Australians to awaken their super. And since the campaign launch, we've received more than 50,000 new member applications to join ART. While brand building is important to the continued growth of your fund, beyond this, our new brand platform reinforces something we firmly believe in. Early and often engagement with your superannuation can improve your retirement outcomes. For those who joined us at one of the 3 information sessions held earlier today, we hope you found them insightful and you'll join us again in the future. Looking ahead, our priority remains on delivering strong investment results, innovative retirement income solutions, and exceptional member experiences, all underpinned by good governance. We'll also continue to align our offering and find additional simplification and benefits for our members. In our next chapter for ART, I'm committed to building upon the great work of our team, leveraging our collective 140 years of experience as we work to become Australia's best retirement savings and income fund. Thanks for your ongoing support and confidence and trust in me, our board, and our team. And we'll work hard every day to re-earn it. I look forward to answering your questions soon.
Thank you, David. I'd now like to introduce Ian Patrick, Australian Retirement Trust Chief Investment Officer. Ian has been with the fund since 2015 and is responsible for leading the investment teams that design and implement ART's investment strategies. Ian has decades of experience in the institutional investment industry and is committed to ART's goal to deliver strong long-term investments and growth of your retirement savings. Please welcome Ian.
Thank you, Beth, and good evening, everyone. I really value this opportunity to reflect on the past year in investment terms with you, and in so doing, I represent the group of excellent investment colleagues I have at Australian Retirement Trust. I know I speak on their behalf in saying that we take the trust you place in us stewarding your savings very seriously. Now, one of those excellent investment colleagues, Brian Parker, did the economic and market update a short while ago. I have to disappoint you. I'm not going to be no match for his jokes, and some of the messages you may have already heard, but I think they're important to reinforce. So, over the next 25 minutes or so, I aim to cover several topics. Most importantly, I am delighted that it has been a strong year in investment performance terms for many ART investment options and therefore your ART savings, continuing our track record from recent years. Now, your investment returns are linked to how investment markets fared in general, which I will discuss, but it's important to say that ART also generated additional returns over and above the market averages and our target returns. An important milestone in the year was delivering the meaningful changes to the suite of choice investment options available to you that came into effect from 1 July 2024. Based on your regular feedback, there is a desire for me to reflect on the investment markets more broadly, both in terms of the past and an outlook for the future. Throughout, I will aim to share with you why I am confident that our approach can continue to deliver resilient outcomes for you, our members. As I am prone to do at events like this, I will emphasize that for most of you here and online tonight, superannuation is a very long-term investment. What happens in any given year is part of a longer-run outcome, and that longer-term thinking is reflected in the investment option you select and the investment strategy we employ for that option. A single annual return sits in a longer-term context. The median return of superannuation fund options can be used to represent the average outcome in the industry. This chart shows the median return for balanced options in each financial year since 1994. As you can see, the individual years show a reasonably high degree of variability. For instance, the 2021 financial year saw the second highest 12-month return across the entire 31-year period shown. In that year, share markets bounced back strongly on the prospect of increased economic activity following COVID. Then, in the 2022 financial year, there was a sea change in investment markets, with the unusual combination of negative returns from both shares and government and other bonds, which in turn led to negative returns for many superannuation investors. Conditions and sentiment started to normalize in late 2022 and into 2023, and investment markets returns largely reflected that economic resilience. Solid returns from share markets followed, leading to the most recent 2 years experiencing a moderately strong return for typical superannuation portfolios. Now, given the uncertainties that existed for markets a year ago, I'm tempted to say that an 8.9% return for the past financial year is better than might have been expected back then. The 8.9% industry average return was achieved on portfolios made up of a number of different asset classes or asset types, as they are known. The chart shows the returns from the major asset classes over that financial year. As just mentioned, shares had very strong returns and underpinned the industry average 8.9% return for the year. Looking at those same asset classes that you just saw over a number of past financial years, there are more accentuated differences year by year. The key points are that the 2021 and 2022 financial years show how drastically markets can turn, and that the recent 2 years have seen international developed market shares perform strongly relative to both Australian and emerging market shares. Furthermore, all asset classes had negative returns in the 2022 financial year, except for cash. Looking at the average return over the 5 years to 30 June 2024 offers a slightly more normalised view of returns. However, the 5-year average returns from global and Australian bonds are still unusually low compared to the 30-year average, indicating how persistent low returns can be. It is also important to note that it is only recently that returns for investing in cash have been higher than 1% per annum, with the result that the 5-year average return for cash is still a paltry 1.6% per annum. To keep the chart somewhat manageable, I have not included the returns for asset classes like real estate or infrastructure, which are also part of many superannuation portfolios. Within real estate, office buildings continued to struggle to retain and renew tenants, depressing prices and contributing to a negative 9.2% benchmark return for that asset class for the year. Infrastructure fared much better, returning positive 6.1% for the year. Try and remember these returns, as I will use them shortly to highlight differences between the returns of different art investment options. I want to move now to some high-level indications of what drove superannuation returns in general to specific comments on some of the art investment options you invest in. Each investment option has a different mix of asset classes. To illustrate the different asset mixes, I have highlighted two examples here, chosen because they help to demonstrate the influence on returns of the mix of asset classes. The balanced risk-adjusted option on the right was formerly known as the QSuper balanced option. The mix of assets in the balanced risk-adjusted option is different to the art balanced option. Each is well diversified, but the fact that they have different weights to the various types of assets, particularly shares and fixed income, means they experience different returns. At 30 June 2024, these options represented two of ART's largest options as measured by member assets. Share returns for the 12 months to 30 June averaged 16%, whereas returns from fixed income or bonds averaged a little over 3%. In the longer term, shares are expected to outperform fixed income, but that difference over the 12 months at 13% was an outsized one and amplified the differences in returns for different investment options, particularly those that held more shares. This, plus differences in returns from the types of shares and property assets held by each option respectively, meant the ART balanced option enjoyed a return of almost 9.9% for the 12 months to 30 June 2024, higher than the industry average for similar options, which are highlighted at 8.9%, while the balanced risk-adjusted option achieved a return of nearly 5.4%. As I just stated, differences in the kinds of shares and real assets held by the balanced risk-adjusted option contributed in part to its lower return in 2024. The balanced risk-adjusted option held less US shares as a proportion of its global shares and more US office property than the balanced option. As Brian pointed out earlier, under the unified ART investment menu, the composition of assets within each asset class is consistent from 1 July 2024. Whilst the outcome of the two options over 12 months are important to understand, it is equally important to consider the longer-term outcomes from the options. This chart is a bit busy, but it shows 4 different cumulative returns over the period from 2011. The bottom dotted line is the targeted return over the long term, which is 3.5% per annum over and above consumer price inflation or CPI. The black line next up is the median return that was delivered by similar investment options in all other funds. The 2 lines further up are the returns from the ART balanced risk-adjusted option and the ART balanced option, respectively. The points to take away from this chart are that both ART options have performed well ahead of the long-term target return in the dotted line and have delivered outcomes close to or better than the industry average of comparable options in other funds. It is not obvious from the chart itself, but the balanced risk-adjusted option deliberately sets out to deliver a smoother ride in terms of variability of returns, and particularly to minimize the size of a negative return when share markets are weak. Over time, it has done just that, and it is a big part of the reason the balanced risk-adjusted option and balanced option have quite different mixes of assets, as shown a moment ago. ART offers you a range of different diversified investment options. This slide shows the returns of our largest diversified investment options by member assets, not just the two that I've been using for more detailed discussion. This chart shows that the return of each of those options has exceeded its 10-year objective for the 10 years to 30 June 2024. So if you have been invested in a diversified option, you have done reasonably well. So far, I've talked about whole-of-year returns. You all know that investment markets don't move in a straight line. This slide shows that pathway for the ART balanced option from its starting point on 1 July 2023 to its end-of-year return of almost 9.9%. In addition to underscoring that returns don't move in a straight line, I'm using the chart as a lead-in to some comments on why markets have been somewhat volatile and why we might expect more of the same going forward. The market events captured on the slide begin to illustrate how markets responded to the prospect of even higher inflation and interest rates by generally weakening early in the period, and the opposite when there were signs that both might moderate. This image is a metaphor to sum up the recent environment. You all likely know the story of Goldilocks. The relevance to tonight is that the phrase Goldilocks environment has been quoted reasonably regularly in financial stories over the last year. That is, would the economy run either too hot, too cold, or just right? Remember, investment markets are anticipatory in that views of the future state of economies and markets influence prices at a given time. Thus, it was the swings in views of investors between which of the three states would emerge, too hot, too cold, or just right, that led to a level of volatility in returns throughout the year. Central banks, like the US Fed and Reserve Bank of Australia, play a key role in keeping economies on a sustainable path. Through setting official interest rates, they seek to keep inflation under control and to manage a healthy level of employment in the economy. Markets have been increasingly of the view over 2024 that the world's central banks have managed to navigate this challenge quite well. Despite the significant uptick in inflation rates around the world in late 2021, after a long period of stability, annual inflation rates have been declining recently. To bring inflation under control, central banks raised interest rates rapidly in late 2022, and those have remained at higher levels than most of the prior 25 years, at least until very recently. On this chart, Australia is the exception, with a reduction in official interest rates still to occur, with more stubborn inflation being the culprit. So far, evidence suggests that central banks may deliver an outcome where economic activity is just right, or an economic soft landing, as some put it. That appears to be the case based on this chart of GDP growth. Even 2025 global growth is forecast to be a healthy 3.2%. Talking of the outlook, I realize that many of you are likely interested in more than just understanding historical returns. Before I expand my comments, I will say that it is always challenging to offer clear views on future markets, as they are inherently uncertain. In addition, short-term forecasts are prone to swings of market sentiment and are definitely not something we rely on for setting long-term investment strategy. I also note that many of these comments are generally prepared in advance, and circumstances can change quickly. Whilst the metaphor of the difference between looking in the rearview mirror versus looking through the windscreen is possibly overused, it is helpful for anchoring my comments. The view looking backwards is always different to that looking forward, and hence the oft-repeated caution on extrapolating the past. But today, those views seem to us to be especially differentiated. As I have alluded to, the period up to 2021 was relatively stable in economic terms. That changed in 2022 with the uptick in inflation and central banks needing to respond to ensure economies did not overheat. Whilst inflation has moderated recently from highs not seen for 25 years, it's likely that the current levels could remain persistent for some time and be more volatile. Persistent inflation will likely cause interest rates to remain higher than we experienced prior to 2022. Higher interest rates generally lead to slower economic growth, and with accumulated savings from the COVID period exhausted and disposable incomes under pressure from inflation, global growth will likely remain quite moderate by historical standards. Lower growth generally means lower company earnings and ultimately lower share returns. To add some additional colour to why we are unlikely to see a return to conditions experienced prior to 2021, but also to point out where opportunities and risks exist for us as investors, I will use a useful construct of selected D words. Defence and destabilisation can be coupled and capture, at least in part, the extent of geopolitical uncertainties in the world. The ongoing war in Ukraine, extreme tensions across the Middle East, and potential for other conflicts require higher levels of government spending, disrupt trade, and generally lead to inflation. So too any trade tensions arising from the long-run dynamics of US-China relations. Sticking with the topic of trade for a moment, deglobalization reflects the fact that supply chain disruptions brought to the fore in COVID, plus national interest considerations, have seen a reversal of the long-term trend of increasing global trade. Nearshoring, by repositioning factories and other components of the supply chain, will likely diminish global growth as the efficiencies derived from globalization are paused or reversed. Importantly, though, all those new factories and logistics require an investment, which is an opportunity for art. The growth in government debt across the world, most particularly in the US, has started to attract increasing attention. Whilst we are only just past the US presidential and congressional elections, and policies are still to be fully formed and enacted, it is hard to see that US government debt will shrink during coming years and will more likely continue to grow meaningfully. That would eventually put upward pressure on yields on government bonds, which then in turn proves challenging in some ways because it increases the cost of capital for all kinds of investments, potentially depressing their prices. However, it could mean better returns from bonds on a forward-looking basis. Decarbonisation refers to the passage to a net zero emissions global economy. The extent of investment required is substantial for electrification and physical risk mitigation, just to mention two, both of which offer opportunities for investors. Nevertheless, those investments could prove inflationary. Demographics captures the theme of general aging of the population in many developed countries and is possibly the one deflationary force on this slide. Although healthcare and other services and lower tax revenue from working populations will add to government debt. Of course, you can imagine the context behind digitization, given the expectations for the benefits of artificial intelligence. It certainly offers investment opportunities in the likes of data centers and other digital infrastructure that ART has already benefited from, but the future implications for growth, inflation, and even geopolitics are uncertain. To summarize, there is a reasonably high degree of uncertainty in the forward outlook. In this environment, investors will likely remain cautious and be responsive to perceived changes in data supporting one thesis or another. This would mean volatility remains high in share markets and potentially other markets like long-term bonds and commodities. A global recession in the next year or two is not completely out of the question, despite my soft landing comments earlier. For the most part, though, the kinds of signals seen ahead of a meaningful recession are not firmly in evidence. In particular, the level of unemployment remains very low for now. You will have picked up that I pointed to several areas of investment opportunity in the outlook. We believe that is good for ART, as well-resourced investors will be able to take advantage of those opportunities, but equally importantly, price the accompanying risks appropriately. I'm now going to turn from reviewing returns and contemplating the outlook to other areas that are important in an investment context. Firstly, a bit about our assets, then reflections on the menu of investment options, and before closing, something on our responsibilities as investors. Going back to this chart on the asset mixes, I would like to highlight the diversification that comes from meaningful allocations to unlisted assets. When you look at the chart, these are shown as private equity, real estate, infrastructure, and alternative assets. Two of ART's key advantages are that we receive strong inflows each year and that we have a good spread of members across age bands. So while we have many retirees, we also have many members who have 20 or more years ahead in the workforce before they will draw down on their superannuation savings. We are also a large fund and can buy sizable portions of unlisted infrastructure and real estate assets. The combination of these factors means we can obtain a return premium for you from holding these assets over the long term. This is a prime example of a benefit of scale and why we expect our substantial size will give us advantages into the future. This year, I am going to highlight a small number of assets that were previously part of only one set of investment options, either QSuper options or super savings options respectively, but each now form part of the portfolios underpinning our unified investment menu. Whether it's ART's majority shareholding in G'day Group or Epic Energy in Australia, or our minority ownership of Heathrow Airport or Long Beach Container Terminal in global markets, the interests we hold in these key assets contribute to returns across options available to all members. You will be aware from detailed communication from ART that we unified the menu of choice investment options available to all members commencing on 1 July 2024. This table is the full menu that all members can choose from, in addition to ART's existing MySuper options, which I will come back to. We are proud of the quality menu of options and that they are available to all members. All changes to move to this menu were based on detailed research, including with members, advisors, and industry experts. In addition, not only can every member now access the same choice investment options, but the harmonization has allowed us to fully integrate the best investment approaches from all our investment activities into each and every option. Given the complexities in bringing about the unified choice investment menu, I want to commend my team and other ART colleagues for the phenomenal body of work completed. I also want to assure you that the investment committee and board oversaw this process with diligence, particularly in relation to aspects of fairness between different groups of members. When we assessed the outcomes of the extensive transition to the unified menu, we were gratified to report that the costs and other measures of prudent execution of the changes have been better than expectations. Furthermore, we have continued to reap benefits for members from the merger through ART's enhanced scale and ongoing harmonisation. One measure of that benefit is savings on investment fees and other improvements to returns for members. So far, we estimate that to be of the order of $100 million, ahead of our expectations at merger. Most of ART's members do not make an investment option choice, Their superannuation balance and ongoing contributions are invested in a MySuper option. Alongside the changes to the investment choice menu I just referred to, we refined our MySuper investment strategies to better align them across all members of ART and to reflect contemporary thinking with respect to managing member savings over their working lifetime. As David mentioned, the strategies now include a higher growth allocation for longer, while continuing to transition members from higher to lower risk investments in their lead up to retirement. A key element from alignment is that all MySuper members under age 45 now have their balances invested in a common way, in a portfolio equivalent to the ART high growth option. Clearly, the ART board, investment committee and team are focused on delivering on our financial objectives to help maximise our members' retirement savings. As a large investor with globally diversified portfolios, we recognise that ART has investments that may potentially affect environmental and social matters within the world our members live and retire in. We acknowledge the systemic risk of certain factors we currently face, like climate change, and the significant impacts these can have on the global economy and society. While climate change poses risks to the planet and the welfare of the people who live on it, the risks are also ultimately financial. For this reason, it is certainly in our members' best financial interests that we understand the reality and address the impact of climate change in our activities and seek out opportunities as our world changes around us. Sustainable investment is a broad-based approach to investing that includes the integration of environmental, social and governance factors, or ESG factors in short. We integrate ESG factors into our investment approach alongside other traditional financial factors because they present key long-term risks and opportunities in our portfolios. You can read more about our approach in our Sustainable Investment Report, which is available on ART's website. Climate change continues to be one of the most topical issues in relation to ESG. ART formally adopted the target of having a net zero greenhouse gas emissions investment portfolio by 2050 at the date of the merger. As noted at last year's meeting, we published our net zero 2050 roadmap in September 2023. The roadmap sets out for you, our members, as well as our other stakeholders, how we currently plan to transition our investment portfolio towards that 2050 target. The roadmap includes a number of interim targets with a target date of 2030, as it is important to have clear milestones to measure our progress towards a net zero greenhouse gas emissions investment portfolio by 2050. We have set an interim greenhouse gas emissions intensity reduction target for the listed equities, infrastructure and real estate asset classes. This is supported by additional interim targets to support real-world emission reductions that are consistent with the 2050 target. We report on progress against the emissions and other interim targets in our Sustainable Investment Report. We intend to review the roadmap in financial year 25, given the evolving landscape and our understanding of climate change. As I wrap up, I hope you will take away some of the following. 1, try and avoid getting too caught up in the short-term sentiment of markets. Using the words of an investor I respect, the real world is generally something between pretty good and not so hot, whereas investment markets fluctuate between thinking flawless or hopeless. Secondly, long-term patterns of return support holding the course if you have the time horizon to do so. Financial advice is particularly beneficial to ensure your investment strategy is aligned to your circumstances and risk preferences. 3, diversified portfolios like those ART invests in on your behalf are one way to moderate volatility over time and protect your savings against the extremes of different investment types. As a general statement, long-term returns from art portfolios have been strong, irrespective of whether the portfolio has been designed to protect against downside surprises or designed to participate in share market strength. 4, even in a world of heightened uncertainty or in periods of crisis, there are opportunities for investment. Art has the scale, disciplined investment processes, and capable team to capture and benefit from those opportunities on your behalf. Lastly, art also has the capacity to invest widely and successfully on your behalf in unlisted assets, and we believe those investments should ultimately benefit from both the return and risk characteristics they bring to your savings. In closing, I assure you the art team takes the trust you place in us stewarding your savings very seriously. I am proud to say the team have again executed that task well this year, especially by delivering both the returns we have discussed and the unified art investment menu. I have great conviction in our capability and our longer-term positioning, and I thank you for your confidence in entrusting us with your savings. I look forward to your questions.
Thank you, Ian, and thank you again to Andrew and David. Now for your questions. Our panel answering questions tonight includes the speakers you just heard from, as well as Helen Rao, Director and Chair of the Board's Risk Committee. Christy Huxtable, Arts Company Secretary, also joins us on stage, and members of our executive team and our fund actuaries and auditors are here tonight and available to answer questions specific to their responsibilities during the Q&A. Throughout the Q&A, we will alternate between questions from the room and questions from our online audience. If you are joining us on the webcast, you can now submit your questions or vote for questions submitted by other members via the panel on the right-hand side of your screen. If you are here in the room, you can now line up between one of the 3 microphone stations. I know I speak for the entire board when I say hearing from you is very important to us, and we want to get to as many questions as we can. We may not get to all of your questions at this event, but rest assured we do look at what has been asked and we publish on our website the answer to questions submitted that we haven't had time to answer. To help make sure what you're interested in is answered, for those online, you can vote for the questions asked by other members, which will help us prioritise that topic. We're pleased to have several hundred in the room, and we also have several thousand online. While we do alternate between the room and online, given the large volume of online members, can we ask those in the room to only ask one brief and concise question? It may be that your question has been asked already by someone else or answered in one of the 3 updates you've heard. You can also submit your question online by speaking to one of our team members at the back of the room, who will have iPads and can record your question in our event system. Finally, please note we won't be able to answer any questions that relate to your personal financial situation or your account. For those personal account questions, if you are here tonight, you can still speak to our team members in the foyer. You can also call us in coming days on 13 11 84. We will conclude tonight's meeting by 7 p.m. Brisbane time. And now to our first question, which we will take from online. And it's from Vivian, and it's to Andrew. In art, is there a sufficient number of independent directors on the board, and how good is the current situation in terms of good governance and necessary oversight?
Thanks, Vivian, and the short answer to your question is yes. The minimum number of independent directors that's required under the legislation is 1 at Australian Retirement Trust. We have 3 independent directors who meet the formal tests set under the legislation and by APRA as the regulator. I would quickly add that all directors on the art board have the same legal obligations, and all of them are required to exercise independent judgment. And I can attest and assure you that that is both my view as the chair and indeed the collective view of the board. I mentioned in my opening remarks that we had 2 new independent directors join us during the financial year. Martin Parkinson and Helen Rao both have had outstanding careers and outstanding reputations here in Australia, but also global experience. It's the calibre of their experience and the quality of their judgment and their experience that I think speaks to the benefit of Australian Retirement Trust attracting quality people to both work at the fund, but also to serve on the board. And our third independent director is Mark Burgess, who during the financial year took over as the chair of the investment committee from one of our previous independent directors, Michael Trail. Mark, again, someone with a stellar reputation both nationally and internationally, is a former managing director of the Future Fund. But across the board, we have both the skills, perspective and experience to provide quality oversight. It's a complex world with changing risks, and so we need the best people to be able to do that. But thanks for the question.
And if I could just add, Andrew, I mean, obviously, from my past experience at APRA, I have seen many superannuation boards and many different governance frameworks and board compositions. And my experience suggests that the art director appointment process is extremely robust, in fact, one of the best in the industry. And it's very much focused on having the right skills and experience around the board, irrespective of whether they're independent directors or member or employer nominated. And that ensures a diversity of perspectives in the discussions that happen, which promotes the robust oversight and the effective decision making that's needed for an organisation the size of ART. And I've found that that's been evident, that sort of quality of governance has been evident in all of the discussions and decision makings that I've participated in across a range of strategic and operational areas in my time, albeit short, on the board. And it's very much underpinned in the strong frameworks and reporting and monitoring and oversight disciplines that we have in place, with a focus on making it better all the time.
Thank you, Andrew and Helen. I'll now go to a second question online from Olwen. From what source does the money in the reserve come from? We will actually turn to David for that question.
Thanks for your question, Olwen. So a lot of members would know that we have reserves at the fund, and those reserves, it's important to note, were really established from our two predecessor funds that came together for the merger to create ART, so QSuper and Sunsuper. They each had reserves, and those reserves were I guess, substantiated from a number of different sources, a number of different events. The regulator, APRA, requires us to hold an operational risk financial reserve so that if anything happens untoward from an operational sense, there are reserves available to remedy the situation. We also have reserves being generated from just the efficient operation of the fund, and there are a number of tax events that have occurred to create reserves. And the reserves are earning an investment income on them, so they tend to grow over time. It's the board's responsibility to ensure the judicial allocation of reserves. It's also the board's responsibility to make sure that there's resilience built into the operation of the fund to deal with any untoward events. I don't know if you want to add to that, Andrew?
Perhaps just briefly to add to David's comment, from a board perspective, the obligation is to make sure that we obviously meet the minimum requirements of APRA. We exceed those minimum capital requirements, minimum reserve requirements. And why is it important to have a good amount of reserves as a fund? For the same reason it's important to have a good balance sheet in any organisation or any business. You want the capacity to invest in technology and capability in new services. You need the ability to be able to withstand events, and that's why you need to be strongly reserved. And the final point to make is that when we run the fund well and efficiently, then any surplus from the operation of the fund goes into the reserves. It doesn't get paid out to shareholders. We're a profit to member fund, i.e. when we run the fund well, we generate reserves which we can invest back in the organisation and deliver new services, invest in the technology, invest in the cyber security that's required for the future, and that's why it's always important to run the fund well and efficiently.
Thank you. We'll now take two questions from the floor, starting here. Thank you. And if you could just state your first name as well.
I'm Frederick, and I've got a question. I think it's for David at this stage. You had two very distinct overhead projector items in relation to China and Australia. The China real growth indication was about 5%, whereas Australia is about 1.5%. And I'm concerned about China, such a big economy, getting such a small response today. Now, I realize that it's only one part of the mix, but I'm very concerned also about the climate-related strategy across the world. So my question for you is, do you and your organization have any input internationally into how China should perform or should not perform on the international investment sphere? Over to you, David.
Thank you. I think this is probably for Ian, and unless David wants to make any initial comments, but we could hand this one to Ian, our investment
But I think it's best
That's all right.
Ian.
Yeah.
Thank you for your question, Fred. I take it in two parts. One is, how do we perceive China in the context of our investment portfolios? China has many dimensions of importance. It's a major export destination for Australian organisations, particularly mining organisations, and as a consequence, the relative health of the Chinese economy is important to us. With regard to ability to influence policy in China, I don't think we as a capital provider have an ability to influence policy in China, but certainly to the extent that we invest in Chinese equities, and we do have some limited exposure to Chinese equities. Bear in mind they are relatively closed capital markets compared to Western capital markets, but to the extent we do, we would hold those companies in terms of their contribution to our financial returns to the same standard. In relation to, let's call it climate change, I don't want to over-dramatize it, but this will be the century of the environment. If the prior century was the century of economics, whereby we discovered how to manage economies well for growth, the current century will be the century of the environment, how we address the investment required to ensure that temperature change isn't significant. And the science is very established in that regard. It will require investment. We will not expend money on members' behalf without it being in their best financial interest. We have an overarching obligation as an investor to invest in members' best financial interest. And so to the extent we invest in an electricity distribution network or a technology startup to address battery storage, it will be with that context in mind. But I have every confidence that investments related to climate transition in its very broadest sense will form an important part of our opportunity set going forward. I hope that answers your question.
Thank you very much, Ian, for your response.
Thank you, Frederick. We'll just go to this microphone now for another question from the floor, and if you could just state your first name, thanks.
Good evening, my name is Deb. I'm sorry it's been a rushed design of my questions. Last year I attended the AGM and asked a question about QInsure, and tonight I'm going to ask another question. As I said last year, robust insurance is critical for any successful wealth management program, and I guess that's what we're all here for tonight. Afterwards, after attending the AGM last year, I spoke briefly with Georgina, the then board member, and she talked with me in detail about her commitment, her deep commitment to delivering for members when it came through to delivering a best practice quality insurance products for our members, and I felt great relief. Since then, I've had many interactions with QInsure, and I understand that we've talked earlier today about not getting personal advice, and that's not what I'm here for tonight. I'm here to talk about the ART's commitment to delivering for members.
So, Deb, if you could just get to your question.
Yeah, sure. So I've got a background in financial planning and systems management. So I have a level of understanding of how it should all work. And from what I can see, there's some deep flaws in the way that the business systems are operated within QInsure. One example is the complaint system. It's not well described on the internet. There doesn't seem to be an established system, and myself, when I've made complaints, I get letters back. I'm not engaged with a complaints process, and it's from just an innate name, Jason, instead of from a unit. It doesn't seem to be a feedback, and it seems as though it's just touching the base. When I raise my concerns, I'm regularly referred to AFCA, and as we know, AFCA is a very overstretched regulator, and I would very much like to work with QInsure and QSuper and ART with these problems, and as a member for the benefits of all. So let's get quickly to my question. Why are the QInsure processes not transparent and available to members on the internet? That does talk about the complaints, that there is a complaint system and you can make a complaint, but it doesn't actually talk about how those complaints are managed within the organisation and ART's commitment. The other question, why is there not a feedback system so that when members such as myself ring up QSuper or QInsure, we get provided with the opportunity to say whether our query has been met that night, that day or not?
Thanks, Deb.
And why is QInsure, why are there not details about the QInsure business in the annual report? And how do members such as myself raise these concerns with board members? How do we access board members to make sure that we can raise these questions with you directly for the benefit of everybody?
Thanks, Deb. We might throw to David for the initial response to your question.
Thanks for your questions, Deb. And I'm sure that a member of our team will be very happy to help you in your circumstances. Our complaints mechanism is widely advertised to members, and we are transparent and clear about what the complaints mechanism is on our website and in our material. We take every complaint seriously. And also the Australian Financial Complaints Authority that you referenced is available for members that aren't satisfied with their complaint and the resolution of that complaint. I take on board any feedback that you have, Deb, about our complaints systems and how it can be improved. As I said in my opening remarks, our posture will be one of everything can be better at art over time, and look forward to hearing your specific feedback so that we can take it on board.
Thanks, Deb. Anything else to add? We'll go to two questions then from online. One from Brian. Does ART use external companies to handle their administration, for example, Link? And David, if you could respond to that too as well.
Thanks for your question, Brian. No, we do not use external companies to handle our administration. We don't have a commercial arrangement with the organisation you mentioned, Link. All of our core administration and member servicing work that we do at ART is done by ART employees, and that's the operating model that we have in place and will continue to have in place for the foreseeable future.
Thank you, David. We've got a second question online from Matt. How often are unlisted assets revalued as part of our balances? So Ian, to respond to that initially.
Yes, thanks, Beth, and thank you, Matt, for your question. We have a range of unlisted assets, as you heard me talk about in my prepared remarks. The major assets, major infrastructure or real estate assets, are valued quarterly, and in the intra-quarter period, we roll what we call roll forward those valuations on the basis of revenue generated and profit received. For private equity assets and private debt assets, those are typically valued quarterly by managers. So the frequency is for the vast majority of our assets quarterly, with some on a 6-monthly basis. But bear in mind, these are operational businesses that don't change that radically month to month or period to period. That's the frequency. How do we go about valuation? We use a cross-section of dedicated valuation professionals that are independently appointed to provide the valuations, and we accept those valuations into our unit pricing. In some cases, particularly private equity and private debt, those valuations are provided by the underlying managers. What do we do if market circumstances change? If market circumstances change, we do make out-of-cycle adjustments, as we call them, to valuations in response to a change in market circumstances, as I say, or dynamics associated with the individual entity. For that purpose, we have a specified management committee called the Valuation Review Committee that will sit and is charged with assessing out-of-cycle valuations. And then there is a board committee called the Valuation Oversight Committee that oversees all valuation processes, including the out-of-cycle process. The auditors clearly review valuations as part of their annual review. Ellen, I don't know if you wanted to add anything.
No, I think you've covered it.
Yeah, I think thanks, Ian. We'll now take 2 questions from the floor, maybe starting in the middle.
Good evening. My name is Vince Garoni. I'd like to put a question to David. David, I think the complaints process is people make a complaint as a form of last resort. I would just like to ask whether the company would actually review it. In my own experience, I have also found that when one makes a complaint, you really have no idea when someone's going to get back to you. I've put a bring up in my diary for 2 months forth, and one has just no idea. So could I just ask whether you could actually review how customers are advised when they will get a response to their complaint? At present, the process, in my experience, hasn't shown that. Thank you.
Vince, is it?
Yeah.
That's correct, yes.
Yeah, thanks, Vince. I definitely do that. We actually have regulatory timeframes that we're required to respond to complaints within. So I'm disappointed to hear that you felt that it was taking longer than you expected, and that perhaps it didn't appear as clear to you when to expect the next step in the process, if you like. So I definitely will do that, Vince, and happy to hear directly from you about what your experience was.
I might just add something from the board's perspective around our complaints process. So complaints processes are governed by regulatory guidance. It's called RG 271 or 272, I think, and so our complaints process is compliant with that. If it's let you down as an individual, then, as David said, we would be keen to engage in that discussion. I just also wanted to pick up the point to a couple of the previous questions, which was, one, our complaints process is compliant. 2, I think you asked the question, Deb, about how do you get to ask questions of directors, and the answer is you just did, as you got to last year and have a discussion, and that's why these meetings are so important as accountability mechanisms and for these issues to be brought to the fore. And I think you also asked about why QInsure wasn't mentioned in the annual report. I'd have to go and check it, but we did change the name to Art Life, and I'm almost 100% sure that Art Life is in the annual report, and that's because we changed the name. So I hope that clarifies the question.
Thank you. Just to the gentleman over here, if you could just let us know your first name, thanks.
Hello. Hello, my name is Tommy, and thank you for taking my question. The Australian Financial Review recently reported that the Australian Retirement Trust would be in favour of using administrative fees to fund a financial advice service for members. My question is, before I jump to the question, I understand that would provide a really accessible service to members, which would be fantastic. But at the same time, it could result in extra fees for a service that certain members may not use. So my question is, what consultation occurred to inform this stance? And I assume forecasting would have been done on how much the cost would be for the service to help inform your decision. So how much would it cost members for that service to be introduced? Thank you.
I might throw it to Andrew first, and I'm sure David might want to add something on this.
So thanks, Tommy. As it stands today, there's a level of advice that is able to be provided to all members for free. It's embedded into the admin fee. What's been proposed in potential legislation that hasn't been legislated yet, and you're obviously a reader of the Fin Review, so you might have read over the last couple of days that it's probably a little less likely to happen than it might have been a couple of days ago, but there is a proposal that we support as an organisation after deep research and policy work about how to support members into retirement to expand the scope of that advice that can be provided to members for free. So the way that the fund works is we charge everyone a flat fee, as you would appreciate, and that's to cover the services that everyone uses. If you are accessing individual advice that is particular to your circumstances, then that is obviously something that an individual fee will be charged for. So it's not a sea change from where we are now in terms of a level of general advice that's provided to everyone versus highly individual advice that you pay for individually. The proposal is that what can be provided to everyone goes up a bit, but if you are still going to access individual comprehensive advice, that would be a fee that an individual would pay for.
Nothing to add there. We've got to take two questions from online then. The first is from Mercedes. Since the merger of Sunsuper and QSuper into Australian Retirement Trust, why do both superannuation funds still have different fees, costs, and two websites in place and operational practices? Over to you, David, I think, for that one.
Thanks, Mercedes. So as I referenced in my opening remarks, and as Ian covered as well, a lot of work went into the creation of our unified investment choice menu, and that has brought a substantial amount of simplification to both QSuper members and also what we call super savings members. And that's been a great next step forward. At the moment, we have two MySuper product authorisations from APRA, the Australian Prudential Regulatory Authority, and one of the things that the team is looking at is how can we further simplify those settings that you reference in your question. And that's a piece of work that's underway, and as I mentioned in my opening remarks, we will continue to look for simplification opportunities and also cost-saving opportunities in the interests of members' economic benefit.
Thanks. Now we've got a question from Brad online. The question is, the performance of the index funds for Australia and international shares has been extraordinary, ranging from 23 to 28% over 12 months, even better than the high growth investment option of 17%. Do you use quantitative AI investing in your index funds? So that's one for Ian.
Thank you, Brad, for the question. It's a very simple answer, which is no. The reason it's a simple answer is index funds, which is what is referred to in the question, are designed to replicate the index that is published for a given market or series of markets. So it is not trying to do anything different to replicating the index. If the index is the MSCI All Country World Index, which is what international shares would be, we are trying to replicate the return of that. It doesn't require any overlay of skill, which is what AI or quantitative AI would imply.
Thanks, Ian. We'll take a question from the floor. If you could just let us know your first name, please.
My name is Trevor. I was at a Queensland Economic Development Queensland, and I noted that the Australian Retirement Trust had made a small investment in social housing, and it was made profitable simply because the government was putting in some money. But given that superannuation is currently $4 trillion and can virtually buy and sell the Australian stock market, It's not going to be that many years before $10 trillion will buy everybody a house. To which, do you see any expansion into residential housing?
Thank you for that question, Trevor. Ian, I think, for this one.
Yeah, thank you for your question. You referenced social housing and residential. Residential would be the sum total of dwellings, apartments, houses, etc. We do invest in residential, both domestically in Australia, but more importantly, quite extensively offshore, where it is a much more established pathway for investment for big investors like us. I think you might be going to, are there opportunities for investment in all forms of residential, including social and affordable housing in Australia, likely to expand? And will we be participants in that? The answer to the will we be participants in that will be if it's in members' best financial interests. As I said earlier, that is our primary source of arbitration as to whether it's a sensible investment or not. With government subsidies, social and affordable housing do work in practice as an investment in members' best financial interests. And more broadly, we're seeing the evolution of what you may know as build to rent, or what you read about in the papers as build to rent, large-scale developments of residential purely for rental purposes. That's an increasing and evolving asset class in the Australian environment, and we anticipate that being an investment avenue of greater interest to us going forward. So yes, we invest in residential. We find it attractive as a diversifier in portfolios. It has specific dynamics in the Australian market, whether it's social and affordable or more broadly residential investment. We will view each of those through a member's best interest lens.
Thank you, Trevor. We might go to another quick question from the floor before we go back to online. So, the gentleman in the middle.
Good evening. My name's Brian, and I was just looking at one of the slides earlier, and I noticed that more than half of the investments were index funds. Could you please go through what an index fund is and how it's different from, say, the standard balance fund, for instance, and the fee structure? Thank you.
Thank you. Over to Ian.
Yeah, thank you for your question. I'll start with the balanced fund. A balanced fund typically refers to a portfolio or a fund that's made up of a variety of asset classes. So Australian shares, international shares, real estate, infrastructure, private equity, and the like. So it's a multi-asset class fund. Typically, an index fund refers to one of two things: either a single index, the ASX 300 index, so that's the index of the 300 largest companies on the ASX in proportion to their market capitalisation or value. An index fund, as I said a little while ago, is just trying to replicate the return of that index as published day by the index provider. It's not aiming to add value over and above the index. You can get index funds, and you'll see on our menu there's something called the Balanced Index Fund. The Balanced Index Fund is made up of index funds for all of those asset classes: Australian equities, international equities, Australian bonds, international bonds. It does not have unlisted assets, so one of the things you take away is index funds do not have exposure to unlisted assets. By definition, they're not listed on a stock exchange and therefore cannot form part of an index. You talked about fees in the last part of your question. Typically, a balanced fund that includes exposure to unlisted assets will come at a higher fee than an index fund. An index fund doesn't require an investment manager who has resources, people, systems, etc., to do work, in effect, you need a very tight but low team-intensive system to replicate the index. So a balanced fund will come at a higher price point than an index fund, but an index fund doesn't have the level of diversification that a balanced fund would have because it doesn't have exposure to those unlisted assets.
Thank you, Ian. With 5 minutes to go, we'll take 2 final questions from online. We have one from Debbie. In 2022, the cost per member was $243. In 2023, it rose to $275. Given its size and number of members, shouldn't the cost per member be decreasing? So I'll throw to Andrew for that one.
Thanks, Debbie, and thanks for the question. And those numbers from memory are ones that are disclosed in a member outcomes assessment, which is published and provided to members. A couple of things to say about that cost profile. One is we've been talking a lot this evening, both in the earlier session and tonight, about an inflationary environment, and inflation is driving costs up, as all of you appreciate in your personal lives and in your working lives and in organisations. Second thing to say is that there is a level of cost in implementing the merger to get the benefits that Ian talked about in terms of the investment synergies and the capability that's required to unlock that. Next point to make is the investment in technology and cybersecurity is one that is ongoing, and that will continue to be a task for Australian Retirement Trust today, next year, well into the future. That is not a task that's going to end anytime soon. But the most important point to make is perhaps this. While the cost to administer the fund, and the fund is growing, as you all appreciate, reflected in the question, what we've done is reduce fees. So if we weren't able to do this in terms of the existing fee structure, as all of you in this room appreciate, we were able to introduce a fee reduction both for the super savings members and also for the government division, former QSuper members, when we implemented the merger. We then have aligned the fee structure to one of the earlier questions, so it's now both a fixed fee and a basis point fee for the admin fees. And the important point to make about that is when we did that and introduced the $1.20 a week fee on the government division side, we also reduced the cap that was paid both in the government division and in the super savings division, so the maximum amount you could pay, that went down respectively from $875 and $800 all the way down to $500. So the effective cap on the admin fee is now $500, which is substantially less. What does that translate to? If you're a government division member with an account balance more than $70,000, you get the benefit of that lower fee cap. You get charged less admin fees in the structure that we've adopted. So in short order, it's costly to run a business, to run an organisation in an inflationary environment and to implement a merger for sure. But what are we doing about that? We're making sure that the admin fees that members are charged have downward pressure on them that were reduced at the time of merger, and that ultimately those rising costs have been absorbed by the organisation. And that's the point of having strong reserves, to go all the way back to the start of this discussion. And our task here is always to make sure that as we face into those inflationary pressures, we keep all expenditure under a particular review and make sure that we have an eagle eye on that to ensure that we can manage the organisation well to your benefit into the end.
Thank you, Andrew. Our last question for tonight is from Abel. The question is, last year there were questions about information security, for example, two-factor authentication. Can we have an update on progress? Thanks. So I'll throw to Helen for that one. Thanks, Helen.
Thanks, Beth, and thanks, Abel, for the question. It is a very important area, and information security in particular, protecting members' money and their personal information, is something that ART takes very, very seriously. It's one of our most significant responsibilities, and one in which we continue to invest and improve what we do every day. We have a lot of controls and strategies in place to make sure that your money and your personal information is kept secure. and that we can respond to any issues or incidents as they arise. We look to align with recognised international standards for security information controls, and actually extend that assessment process and obligation to any service providers that we use on our behalf. And we'll continue to invest to improve those on an ongoing basis. I would actually encourage all of you, if you haven't already, to visit the Protect Yourself Against Fraud page on the website to learn more about what you can do. It's got some good, useful tips and tricks that you can follow to help us protect your information. Specifically on multi-factor authentication, it is in place on a number of our systems. It's been implemented on member websites and mobile applications, and it currently requires members to contact Arts Member Services to be able to opt in. We are looking at self-service MFA capability to be delivered later this year, which is very close now. I'm not sure exactly what the timing is, and that will mean that members will be able to enable multi-factor authentication themselves.
Thank you very much, Helen. Unfortunately, we've run out of time, so I now formally close our 2024 annual members meeting. If you're lined up behind a microphone, and there is no one lined up behind a microphone, we could actually pose the questions that were left over and record the responses to those online, but we've run out of people in the room to ask questions, so that's fantastic to see that all of your questions have been answered tonight. Thanks to our panellists, and thanks to all of you for being part of Australian Retirement Trust's annual members meeting. You can expect to see the answers to the questions that we haven't had time to answer from online, along with the minutes and a video of the meeting at our website in the next few weeks. We want to continually evolve our annual members meeting to meet your needs, so we hope you can take time to complete a short survey that we'll send you. We'll also continue to look across the sector to learn from how our peers are serving their members through their annual member meetings. Thank you again very much for joining us tonight. It has been a privilege to serve you this year, and we thank you for the trust that you place in the entire ART team. We look forward to continuing to work on your behalf in the year to come. Best wishes and good night to you all.